This is Mark Sobel. I'm the U.S. Chair at OMFIF. Today, I have the great honor of hosting Don Kohn to discuss yesterday's FOMC meeting and the recent Brookings University of Chicago report of the Task Force on Financial Stability, which Don and Glenn Hubbard co-chaired. Don is now at Brookings. He's rightly known as a legend for 40 years of service in the Fed, including as Vice Chair, Secretary to the FOMC, and Director of the Division of Monetary Policy. He's rightly known throughout the world as an expert on monetary policy, macroeconomics, and financial regulation. OMFIF's European audience well knows him for his service on the Bank of England's Financial Policy Committee. And since I have the floor, I would say the following. I had the honor to deal with him a bit during my Treasury career, and beyond his obvious brilliance, he's always been a kind, gracious, generous, and thoughtful individual, and one of the most decent and outstanding public officials I ever had the good fortune to meet. I'm going to ask Don a few questions for the first half hour, and then I'll turn it over to Krishna Guha and Anna to be lead discussants. So just take a few minutes. Audience can submit questions via the chat function, and I'll either call on people directly or pose questions depending on how the circumstances evolve. So Don, let's just start with the FOMC. I think it was expected to be a fairly status quo meeting. What was your general take? Anything that stood out in the statement of the press conference for you?
Thank you, Mark. It's great to be on with you. I can't possibly live up to that introduction, but let's try. I think the FOMC was largely as expected, but that doesn't mean nothing happened, because they certainly signaled us that they were somewhat more optimistic about the outlook and the way things were going. They signaled us that they saw progress towards their goals. They're not substantial progress yet, which is what they need for what they said they need to begin tapering their purchases, but they did see progress. They've begun that discussion about tapering. The timing, the composition, the pace of tapering. They haven't reached any conclusions. Chair Powell said that this would occur over several meetings, so he was trying to make sure our expectations weren't for something that might happen very, very quickly. But so there were no surprises, I would say, but there was some progress there. The other point I would make is they did announce a standing repo facility. And this actually bridges the two subjects we're talking about today. A standing repo facility against treasuries was one of the recommendations that our task force made, to have a backstop for the Treasury market. Treasury market, the most important, U.S. Treasury market, the most important foundational market for the global financial system. It's got to be operating, functioning reasonably well. We'll come back to this. We have a bunch of different recommendations, but one of them was this standing repo facility. So I see this as helpful. No, there are no guarantees about functioning the Treasury market, but certainly it's hopeful in that regard. And I would also say that it's a precursor to tapering, because I think having this repo facility in place helps to limit, should help to limit adverse price reactions in the Treasury market in any case. So I think that was an important, that was for domestic. They also announced a repo facility for foreign official holders, central banks and other official holders. That was important too, because a lot of the disruption, a lot of the selling in March of 2020 came from foreign holders. So they've tried to put in place facilities, functions to limit disruption to the Treasury market for whatever reason.
Well, great. Well, let's dig in on macro then a bit on the dual aspects of the mandate on labor markets. Powell seemed to emphasize quite heavily that there was still plenty of slack in the job market. On the inflation front, he seemed to tilt fairly hard towards the transitory side, even though he acknowledged uncertainty. I appreciate your take on that, and whether you worry about there being more pent-up inflationary pressures due to rents and equivalents and the like than meets the eye. I think the data don't back up the generalized camp. I think that inflation may persist longer than the transitory camp has suggested up till now. So how do you see the inflation picture, and what would make you nervous?
So let me start with the job market part. I think that's the harder. They said they need to see substantial further progress towards both of the goals, inflation and maximum employment. I think Powell admitted, and other members of the open market committee participants have admitted, they've crossed that barrier with respect to inflation. Inflation is higher. They expect it to come down, but only to the 2.1, 2.2 area. So they've already made that progress. A really hard question, and it's hard analytically, hard from a policy perspective, is on the labor market side. So if you talk to households and businesses, they say labor markets are very tight. I mean, look at the Conference Board survey of consumer sentiment that was released, I think earlier this week, showed that the difference between households thinking jobs are plentiful versus jobs scarce is leaning towards the plentiful side by the most since 2000. So households perceive tight labor markets. There are a number of openings in labor markets. People are quitting jobs. Businesses are competing hard for new labor. So I think households and businesses both see these markets as tight. The Fed's position is that they're tight now, but they won't be so tight in the future. They're tight because of constraints on the supply of labor that will work themselves out over time. The unemployment insurance, the search costs and time that it takes to hook up someone with the most appropriate job, the childcare issues, all these things will be solved with time. And as kids go back to school in September and the extra unemployment insurance comes off for everyone, labor supply will increase. And they're basically keeping their foot on the accelerator of monetary policy, the QE purchases, in order to make sure demand is there to meet that supply when it comes on. But I think, so Jay Powell defined, what was he looking for? He was looking for large increases in employment. That being held back by supply, not demand. Monetary policy is a demand tool, not a supply tool for the most part. So it's a tricky, the labor market judgment, I think, is a very tricky judgment right now, both the analysis and the judgment about where it's going. On inflation, I think there's a huge amount of uncertainty here. I agree with that. True Knightian uncertainty. We just haven't been in this circumstance before, not in modern times. I agree with the Fed's basic story that many of these supply constraints will be relieved, as we just talked about in the labor market, but also the supply chain issues, computer chips and things like that, as demand shifts back from goods to services. That should ease some of these supply chain issues. But I still, so I think people return to work, et cetera. So I do think they should ease. The question is, will inflation really go down all the way back to the 2.1 thing? And there, I think at a minimum, the risks are on the upside. You've got a lot of pent-up savings that consumers can use to support demand. Yes, fiscal policy is likely to will turn much less accommodative next year, might even be somewhat contractive, but you've got private demand that will remain strong. You have very easy monetary policy, low interest rates contributing to that strength in demand. And it's not clear that the labor supply will come back to the path it was on before the pandemic began. So I do think the risks are that the demand supply imbalance is alleviated, but doesn't disappear over the next, let's say, 6 months, and that keeps some upward pressure on inflation, not the 4 or 5% stuff we're having now, but more like 2, 3, more like 3 than 2, and that begins to get built into expectations and wages. So I think the basic Fed story is correct, but whether it goes back as far as they say it's going to, I think is an open question on inflation.
All right. Well, thank you for that. Well, maybe we can elaborate then a bit on where you started, that substantial further progress that has not yet been met. You cited that you noted the sentence about the committee will continue to assess progress in coming meetings. I thought the S at the end of meetings was the most significant letter in the statement yesterday. But what are your expectations about taper, when it will start, how it will proceed? Will we hear anything about this at Jackson Hole? And I can't help but resist the temptation to ask you, where would Don Kohn put his dot?
So I think I see some announcement happening this fall. So whether it happens in September or October, and then tapering beginning either at the very end of the year or at the beginning of the next year, and then being very gradual over 2022. Now, I think the issue for the Fed will be whether, when they get to September, whether they'll have enough information about their expected relief of these supply constraints to announce the tapering, or whether they will want to wait another month to see better what's developing after as September and October go on. But I expect a fourth quarter announcement on tapering, and then tapering over 2022. I don't think we'll get anything very specific at Jackson Hole. I would expect Chair Powell to perhaps lay out a framework and to think about what would constitute further progress and how this fits into the framework that the Fed has. That's one possibility. I think the other, if it's an FOMC type announcement, it ought to be made by the FOMC and not by the chair at Jackson Hole. I think the other possibility is he actually addresses the subject of the conference, which is the unevenness in the recession and recovery. And I would say that unevenness is not only domestic, who it has hurt and who it has bypassed, but also international, Mark, in terms of as the IMF has pointed out very recently, the contrast between the industrial countries that have the vaccines and the developing countries that don't. And all these can have an interaction with how the Fed is looking at its monetary policy. I think it would be actually quite useful for the chair to lay out a framework of how the Fed is factoring in this unevenness to its policy considerations. But I have no inside information. Let's be very, very clear about that. And he was very not forthcoming yesterday when someone asked him what he was going to talk about at Jackson Hole. Where would Don Kohn's dot be? I would be certainly in the 2023, get going on the interest rate increases. As I said, I think by the language, assuming I had voted in favor of the announcement said when they get to full employment and inflation is at 2 and likely to remain at 2 or higher, if my projection was anything like the median projection of the FOMC, I think I would be forecasting that we would be lifting off. We, the Fed, would be lifting off in 2023 is consistent with what they've said. So I don't see any reason, unless you, there may be some people, participants at the meeting who had weaker economic projections, weaker inflation projections, they might not lift off. But I think it's not surprising to me at all that the median forecaster had 1 or 2 increases in 2023, and I think that's appropriate, especially since, as I just noted, I think there are upside risks on the inflation side.
Okay, well, thank you. So just not late 22, and you expect a gradual taper that treats agencies and treasuries broadly similarly.
Yes, I mean, I could see, first of all, Chair made it very clear that they weren't going to start the agencies before the treasuries. They were both going to start at the same time. He said it was an open discussion about whether they should taper the agencies a little faster than they tapered the treasuries. I can see an argument for that. I actually have been kind of hoping that they would acknowledge the financial stability risks in the housing sector by maybe shifting some of those agency purchases to treasury purchases. So keep the overall total the same, but shift from agency to treasury. That doesn't seem to be on the table. I thought that would be constructive for them to acknowledge that they had more than one tool. There's the total and the makeup, and do something to address acknowledge the issues in the housing market, but they've chosen not to do that. So I do see it gradual. I think they need to be careful about autopilot. So I think they got in a little trouble on the autopilot for tapering and for the runoff of the portfolio last time. They need to acknowledge that the taper and then the runoff could be adjusted based on incoming data, even if their expectation is gradual and transparent.
All right, well, let's shift gears. You co-chaired the writing of the Financial Stability Report for Brookings and the University of Chicago. As I mentioned, it's an excellent report. Since banks were strengthened after the global financial crisis, the report bears down really on non-banks. I thought your work on Treasury markets, mutual funds, and CCPs in particular were quite important. As you said, the Fed adopted a standing repo facility yesterday. No doubt they read your report. You point out that money market funds also were a flashpoint in 2008 and 2020. So could you give us a brief overview of your report? Thank you.
Well, I think you've just given it. Let me elaborate on those 3 areas. So yes, we did focus on the non-bank finance. I think one thing to say is that this report was conceived in the fall of 2019. So it was before the developments of March 2020, and it was conceived with the focus you just mentioned, Mark, a focus on non-banks, on the analysis really that the bank financial positions had been greatly strengthened post global financial crisis. That didn't mean that bank regulation, capital liquidity regulation was perfect. It could always be improved in one way or another, and we have some suggestions where it intersects with market functioning, but that by and large the banks were much safer, but that the unfinished business was on the non-banking side, which is much harder, I think, to deal with, given the way it's regulated and given the very much global nature of that stuff. So we even before March of 2020, we were focused on non-bank and focused on those subjects that you just raised. So let me go over each of them. On the Treasury market functioning, the Treasury market, of course, is the foundational market for the global financial system. Other securities, both in the US but also abroad, are priced against Treasury securities. Hedging, risk management is done with Treasury securities. The liquidity requirements that were placed on banks and others after the global financial crisis presumed that liquidity could be met and dealt with through Treasury securities, selling them at reasonably certain prices. In a crisis, they were a source of liquidity. We already had hints before March of 2020 that there were problems there. There was a repo market eruption in September of 2019 that caught the Fed and market participants by surprise. There were flash crashes before that. So it seemed evident that the market, particularly with the deficits even before the pandemic set in, that the US and other countries were running, but particularly the US was running, that the market was growing faster than the capital that dealers were allocating to making the markets. And that the market, as a consequence, market liquidity wasn't keeping up with the size of the Treasury market, and this was dangerous. And in March of 2020, those chickens came home to roost. So you had a flight to quality and to cash, and the foundational safe asset for the US and global financial systems, prices went the wrong way. So interest rates on Treasury securities went up. The Fed, to its credit, recognized the problems very rapidly. It made unprecedented, huge purchases of Treasury securities, as well as ramping up repo operations in the second half of March and April. I think over March and April, they bought $1.5 trillion of Treasury securities, more than was purchased, or about the same as was purchased in various QE programs coming out of the global financial crisis in just a month and a half. And then they kept up the purchases. And when they engaged in them, they said this is for market functioning purposes. So something's broken. I certainly agree with many who have said, look, you're not going to ever insure against a once a century development like a pandemic with the huge uncertainty that's there. But I do think what happened in the Treasury market underlined, emphasized the problems that were already there, and those need to be taken care of. So one way to take care of them is to make sure that the Fed is there as a backstop for that market. And that's the sense of this repo facility. So dealers and others would be willing to buy Treasury securities, avoid those price declines, if they were sure they could finance them. The Fed's repo facility provides that assurance that they can be financed at a small penalty rate, so it's only used at a certain time. So it protects market functioning. I think the public good of a functioning Treasury market far exceeds the moral hazard that might be created with this facility. But the second angle we pursued at this, and the G30 report was broadly similar to ours, was one reason that the investment banks were cutting back, or at least not expanding the capital that they applied to making market and Treasury securities, was the leverage ratio. So the leverage ratio is a capital ratio that applies the same capital charge to risk-free assets as it does to risky assets. So if you're concerned about coming up against that capital charge, you're going to favor risky assets. You're going to stand back from taking on risk-free assets with the very high capital charge if it's a constraint. The leverage ratio was meant to be a backstop against game playing and miscalculations in risk-based capital. I think the risk-based capital regime has been strengthened considerably over the last 10 years, in part through the stress tests, but other things too. And leverage ratio needs to return to its backstop thing. So and there's some GSIB stuff that goes the same way. So our recommendation was that reserves be permanently released from the denominator leverage ratio. There are other ways of pursuing this, but I do think we've got to take that leverage ratio constraint away from making markets and treasury securities. Two other recommendations in the Treasury market functioning area were more central clearing for treasuries, which would facilitate risk management and would free up capital because of netting through central clearing for treasuries and treasury repo, and greater transparency in that market, better information. On open-end funds, I think we saw, as I say, we saw in the fall 2019, we saw a problem there. Open-end funds, mutual funds, are liquidity, transform liquidity. They promise end-of-day redemption or next-day redemption against assets that don't have markets that work that way. So they're promising greater liquidity to their holders than the underlying assets. So they're transforming liquidity. That liquidity transformation in a crisis situation, in a stress situation, that liquidity transformation creates a first mover advantage for the people who get out early and can get liquidity from the mutual fund that might be obtained by selling treasuries rather than corporate bonds or something like that. That first mover advantage, that incentive to get out of the mutual fund then creates a run on the fund in the stress, and the fund ends up selling both treasuries and corporate bonds. And we saw that certainly in March of 2020, exacerbating the problems there. We also saw problems in the money market funds, the prime money market funds that hold a lot of commercial paper, which is not very liquid. There isn't an active market in that, and they were redeeming things, and that froze up the commercial paper market. So central banks had to intervene both in the corporate bond and in the commercial paper markets because of the first mover advantage and the run and fire sale stuff. So our suggestions for the money market funds was always on swing pricing. Make sure that when there is stress, that people who get the instant liquidity pay for that instant liquidity by pricing the underlying asset better and taking off those gates that I think incented the threat of gates coming down on redemptions that I think incented first mover advantage. And then for the bond and loan funds, we suggested also swing pricing, and where the underlying asset was so illiquid you couldn't come up with a swing price, create a new kind of fund that had that you couldn't redeem just on a daily basis. You could redeem and then you might get your money back in a month or 2 months, depending on the underlying liquidity of the fund. And then very briefly, for the CCPs, of course, they concentrate risk. For the for-profit CCPs, there's a tension between their incentives to put as little of their capital at risk as possible, and then to push that onto the member clearing firms. The member clearing firms feel threatened, feel that there's a lot of uncertainty about what they would absorb, and in a stress, the CCP could become a channel for transmitting financial instability. So our recommendation there was more skin in the game for the CCPs, better certainty on how things are passed through to the members, and enhance Federal Reserve oversight over systemic CCPs.
Great. Well, thank you for that. It's an excellent report. Everybody can find it online. So maybe we can take about 5 more minutes max. I have 2 questions for you, one small, one bigger. But first, the Fed has financial stability responsibilities, but non-banks are outside of its remit. On mutual funds, the SEC is in the driver's seat, but its focus is investor transparency and not financial stability per se. So does the SEC need a financial stability mandate? And do you have anything to say to Gary Gensler?
I have a lot of confidence in Gary to act in the public interest, so he doesn't need my advice. But I think I think every member of the Financial Stability Oversight Council needs to have a financial stability mandate, so that in addition to the transparency, investor protection, market functioning stuff, they take account of the effects of their actions on financial stability when they're proposing things. So they need a mandate, they need an office of financial stability, so they have some staff dedicated to looking at that, and they need to take account of those things when they're making rules. So the SEC, the CFTC, everybody sitting on FSOC needs a financial stability mandate.
Well, great. Well, then last question. Dodd-Frank created the FSOC to act as a macroprudential regulator. Many find it cumbersome, ineffective, particularly in the last administration. It has designation authority for non-banks, and it used it for financial market utilities, but it hasn't designated any funds to the best of my knowledge, even if some funds have trillions and trillions of assets. It says it's going to focus on the activities of non-banks, but beyond pointing to leverage and interconnectedness, it's never been clear to me what the activities-based framework is or how it's concretely implemented. You served on the Bank of England's Financial Policy Committee. In 2014, you wrote an article comparing the FSOC and the FPC, and you made quite clear that the FPC is a more powerful body. What's your take on the FSOC? What would you recommend to your former colleagues, Janet Yellen and Nellie Lang, that they do within the realm of the possible to strengthen the FSOC and perhaps make it more like the FPC?
Well, our task force, let me answer that in the context, our task force recommendations, and we had a number of recommendations for FSOC. We share your concern that FSOC has been less effective than perhaps was hoped when Dodd-Frank was, certainly that I hoped when Dodd-Frank was passed. I think, and some of these recommendations would take legislation, but I think one, so the financial stability mandate for all the members of the committee is an important one. I think it's important that our recommendations, and this would take legislation, would be that the annual report of FSOC be issued by the Secretary of the Treasury alone, and the member agencies would have appendices that could comment on it, but to focus the accountability in one place. My understanding from talking to people who have worked on FSOC annual reports is that finding a consensus, mushing this together, finding something that every agency can sign is, it really dilutes the power of the thing. So we wanted to increase the accountability. We have a recommendation for the Office of Financial Research that it focus on data. Many of the people we talked to about financial stability risks said this is really hard to analyze because we don't have data, we don't have information. The agencies complain about each other not sharing information and not sharing information with FSOC and OFR. So we redesignated OFR as a controller for data and resilience, focusing it on data and having it work with the agencies to get the data that would be necessary to make the analysis. On designation, which you mentioned, Mark, it really hasn't been used except for financial market utilities, certainly in the last administration, undesignated things. Our suggestion there was that there be a regular review of large either activities or entities, that particularly those that had grown over previous years, that the staff would be required to make and publish for FSOC, and then FSOC would have to decide whether this was or was becoming a financial stability issue. And also noted that I think one of the problem with designation in Dodd-Frank is it's an on-off switch. Either you're designated, in which case you have the Fed in there, and people concerned that the Fed will apply bank type regulation to non-bank entities, or you're not designated. So we thought there might be a third way in between that, where some types of activities or entities would have enhanced regulation, but not necessarily by the Fed. So yes, we try to reform the designation process and make it more effective.
Well, great. Well, let me ask Krishna Guha if he could join us and maybe offer a comment and question quickly on the macro and monetary policy situation. Krishna, can you join us?
Thanks so much for your remarks, typically very insightful. Mark's asked me to concentrate on the macro monetary policy side, so that's where my comments and question will be. So I guess my takeaway from your discussion was that I was struck that you appeared to be open to the possibility that the tapering decision could come as early as September, despite Chair Powell's description of a ways to go on the labor market side, and the reference to discussions continuing over coming meetings, plural, that I and many others in the market had read as guiding that this is more likely a November, December type decision than a September decision. My question to you is really, when we think about the remaining meetings of the year, September, November, December, what are the factors that will, in your mind, determine when the Fed feels comfortable making the call on tapering? Is there some state contingency here with respect to realized job gains or unemployment rates? Or is it more a question of the visibility that they feel they have into the evolution of the data and the likely evolution of that data further over the coming months? How would you think about the handicapping September, November, December? And finally, what would it take to push the tapering decision past the end of the year?
Right, so great question, Krishna, and it's good to see you too. I think I take your point. September may be a bit early to make the call. I guess what I see is they will continue to feed us sort of forward-looking. Here, we're considering these things. Here's the progress we're seeing. We're not quite there yet. We are there. So I see this as maybe not an on-off switch. Here's the thing, but a process. And so I take your point that September might be a little early to throw the switch and say definitely we're tapering in December. I think that's quite possible. I do think so. It could be a November decision for January tapering or something like that. But as I said, I think it's a process. I think your point about state contingency is an important one. So it's obvious that on the labor market side, they're looking for good gains in employment. And I think what could pull it forward to September would be two huge gains in July and August that made it obvious that the labor market was really recovering very, very rapidly. What could also pull it forward would be a sense of inflation expectations rising beyond that range that it occupied from, let's say, 2011, 2012 through 2018, 19, right? So if it looked like it was getting to the upper end of that, I think that could pull it forward. And likewise, what could push it back would be weak labor market reports, inflation expectations by various measures going down or not going up any further, a sense that wage gains were not accelerating. So I would hope monetary policy is state contingent. Good monetary policy should be. So yes, they'll keep a careful eye on both aspects of the dual mandate.
Mark, do I have time for one more question, or do you want to move on?
If you have a quick follow-up, go ahead.
Yeah, so my follow-up question actually related to bond market developments. So in recent weeks, in particular since the last meeting, we've seen significant declines in bond yields. We've seen extraordinary lows in real yields, and some reduction in net and inflation compensation to levels that are at the low end of what might be in the long run consistent with the Fed's objectives. Chair Powell was asked about the bond market in the press conference, appeared to be somewhat puzzled as to what was going on, and disinclined to take a very strong signal from this as an important input into Fed policy making. So what do you think's going on? And to what extent do you think the Fed should be putting weight on the signal from the bond market, which seems to go in the opposite direction to the focus on concerns about excess inflation?
Right. So I think they should put some but little weight, but only a little weight on the bond market and the implied inflation compensation, for example, and real rates. So I think they need to take that together with their analysis. I guess I would, I think Jay Powell did the right thing by being uncertain about what's causing the bond market doing what it's doing. Clearly, I thought an interesting response he gave was on the Delta variant and noting that successive waves of the virus had less and less effect on economic activity. So I think partly what the bond market is reflecting is an expectation that people will pull back and that this will damp the recovery, and that will hold back tapering, and then increases in rates, then lift off later. And I think what you heard from him, and I agree with it, is some uncertainty about whether that analysis is correct or not.
Great. Thank you for that. Anna Gelpern, could you join us?
Thank you, sir. Well, it is a privilege to be here and great to hear Don's thoughts, particularly in light of the recent financial stability report from Brookings and Chicago Booth. And really, congratulations on a mammoth, comprehensive labor of maybe love, or love enough anyway. So there's a lot to love about the report. And in particular, I really appreciated the focus on the kind of structural institutional details of the Treasury market. I think there's a lot of conflation of kind of safety and liquidity out there. And I think that the report's focus on what it is that might make the Treasury market the biggest, best, deepest, loveliest market in the world is absolutely critical, that it's made up of institutional actors, each of which operates in response to incentives. I think that kernel is just super important there, and I hope that it doesn't get lost. More seriousness on insurance regulation, domestic and international, I think is absolutely critical. I think that, ever since the London hedge fund of AIG had its adventures, the fact that we're still having the offshore frolics conversation in the insurance space is important. And again, I really commend the group for focusing on that. The attention to CCPs through the cycle, I think is critical, right? So there's been a lot of talk about kind of CCPs concentrating risk, but I do think that through the cycle margining is an important recommendation. And your more granular approach to the role of the housing market in financial stability is interesting and important. Again, the focus on servicers I like a lot, and the also automating crisis response, I think matters, and matters also ex ante in this world. Now, where I'm scratching my head a bit, all in love, is in the structural recommendations, right? And I sympathize with your with the impulse here that FSOC did not turn out to be what we had hoped it might be, but it reminds me a little bit of the back and forth in the UK in particular, which you're very familiar with. You bring everything into the Bank of England, you boot everything out of the Bank of England. No, wait, you bring everything in, but then you split it up, right? If in fact information and accountability are the problems, right? I'm struggling to see how having more reports and more appendices would achieve more accountability rather than more noise. I mean, I recall, I think David Wessel was saying in kind of introducing your the report that, well, this is very complicated stuff to outsiders. Well, golly, I get more financial stability reports than I get Christmas cards. Maybe I don't have friends. I probably don't have friends. But, that really weighed on me a bit. And I do wonder whether more information and more output, if you will, rather than more muscle, to be crass, is the answer. And then I do have a question about, maybe you could just elaborate on the how the role you're proposing for OFR would interact with the Fed's information function, if you will, and sort of data collection, and the kind of the Fed's role here as one of the, central banks have been quite good at kind of sucking up information in a centralized way.
Great.
And then the last point, last word, kind of the international dimensions of this, I think really could, I would love to hear more about those and the implications of your recommendations. Okay.
Thank you.
Thanks.
All right. Thanks, Anna, for those very kind words on the report. Let me focus on your three questions. Well, first of all, we had a discussion about muscle and whether one should create an independent financial stability organization, agency, with an independent head, not the Secretary of the Treasury, with a defined term of office, etc. I think we were some of our members favored going in that direction. I think there was some concern about the direction the Supreme Court is going and whether that would survive a legal challenge, particularly for a single-headed agency, but even an agency with, and that it would be more productive to fix what we had than to create a new agency. But I agree, we had a good discussion on that. Will more reports fix what we have? No, I agree. But our attempt was to place more accountability for those reports in the agencies that produced them, and not to have this drive to consensus for the annual report. Make it so much mush. So I think dividing it up with the Treasury Secretary having to take responsibility and having to think about what will happen in 3 or 4 years if something breaks, and she didn't point it out, I think will be helpful, and will give Congress a much firmer point to hold people accountable. And then the financial stability mandates for each agency, I think, and Congress would have to pass that, and Congress would have to hold those folks accountable. On OFR and data, I think Fed does not have a lot of data that's not bank related or related to the New York Fed's operations. So very focused in the Treasury agency market. And even there, as we saw in our report and also in the G30 report, there were lots of recommendations. G30 report on Treasury market didn't have to say anything about OFR, but they had very strong recommendations about much more visibility into the Treasury market, the foundational market, where they noted that the visibility into trades and treasuries is less than the visibility into trades and corporate bonds, and that the oversight of the Treasury market suffered as a consequence. So I think we approached that by saying OFR should focus on it. They had some very specific things, but I do think data outside the banking system are not as available as they should be, even beyond the Treasury market, and available to researchers like yourself who might be able to use that data to analyze what was going on. On the international aspects, I guess we didn't have anything specific there. I do think for when you get outside the banking system, the ability of trading to flow from one jurisdiction to another jurisdiction is another aspect of regulatory arbitrage. And it is very important that the FSB and the various coordinating functions for securities markets, et cetera, be on board with this. And I'm encouraged by the impulses, by the analysis that these international organizations, BIS, FSB, et cetera, are doing now. So I agree, it's really important, particularly outside of banking.
Thank you. Music to my ear to hear a Fed person praising the FSB. I remember when it wasn't necessarily so, and I was on the Treasury side promoting the FSB. We have some interesting questions in. Obviously, in 2013, tapering caused a huge market ruction. So far, nothing, but are you worried about a negative reaction? How can it be mitigated?
Well, I think the Fed is very focused on the taper tantrum and avoiding that taper tantrum. And that's why they're giving us, as Krishna noted, these warnings. This is going to occur over several meetings. We're going to give you plenty of notice. And I also think it's why they've very clearly separated the liftoff criteria from the taper criteria. So my analysis of what happened in 2013 is the Fed somewhat unexpectedly said, we're beginning to think about this taper. We may have something in the next few months. And people interpreted that as they're bringing forward liftoff. And I thought the taper tantrum was more a product of the markets bringing forward liftoff than it was of the taper itself. So I think the Fed in its announcements have been very clear about the criteria it's going to use for liftoff. And Jay Powell has been very, very careful to say, yes, we're beginning to talk about taper. We're talking about taper, but we're not talking about liftoff yet. So I think they're very aware of it and doing all they can to avoid that kind of reaction.
One questioner asked a question noting that Chair Powell avoided responding yesterday to the Fed's question relating to the Fed's reaction in case inflation proves less transitory while employment doesn't make substantial progress. The questioner asked, how do you think the Fed is likely to respond to such a scenario, and which tools, forward guidance, QE, or rates would be prioritized? You know, I know a mutual colleague, friend of ours, Nouriel Roubini, has been talking about stagflation, the great stagflation coming. How do you think about those issues?
So I think Chair Powell did note, if I recall correctly, that there is something in the framework document, the January document about strategic objectives and monetary policy strategy, about trade-offs in that circumstance, and taking a little on the inflation side and a little on the output side. So I think they would be forced to really confront an issue, which is maybe we won't get back to where we were, or the trend we were on in the end of 2019, early 2020, and they'll have to decide whether the stagflation is temporary or permanent. I do think, and in the past, and I think this is still true, maximum employment was defined to be the level of employment that was consistent with price stability. So they may end up, if there's a permanent stagflation issue, they may have to redefine their maximum employment and put priority on price stability. So I think it would force them to make some very difficult, obviously some difficult decisions, but my hope and my expectation would be ultimately the price stability mandate will be adhered to.
One would want that financial stability issues are separate from monetary policy issues. The Fed has a dual mandate, but it also has financial stability responsibilities. And then there's this whole non-bank world where where problems there can rebound on the Fed's ability to achieve its dual mandate. Do you think that, first of all, even if not part of the dual mandate, that financial stability needs elevation in the Fed's reaction function? And do you think the Fed needs to be more outspoken, given that what can happen in the non-bank world can impact its ability to achieve its dual mandate?
So the answer to your first question is no. I don't think financial stability should be an independent factor in the Fed's monetary policy, at least not under 99% of the circumstances. So I've long maintained that monetary policy is the last line of defense in the financial stability world, that using monetary policy for financial stability purposes, that is raising rates, means that you fall short of your price stability, maximum employment goals. It has a lot of costs. So I wouldn't rule it out, but I wouldn't make it a regular part of monetary policy. I do think on the second point, my answer was yes. I think the Fed ought to be more outspoken, or I hope the Federal Reserve is pushing within the government right now, when they have a receptive audience within the government, for more and more effective tools to deal with financial stability issues outside of using monetary policy and outside the banking system. One example would be in the mutual fund area, and the open-end funds, the money market funds, and the bond funds. For example, another area would be in what I cited in the CCPs. One of our recommendations was that the Fed take a more active interest in oversight of the systemically important CCPs. Right now, they pretty much defer to the CFTC, maybe better cooperation there. So I think there are things the Fed can do to reduce financial stability risks without resorting to monetary policy. And I hope they're doing it behind the scenes, and I would welcome more putting pressure through their financial stability report and the speeches of the governors on these issues.
Well, great. Well, thank you. There are more questions, but time is run out. You're going to be spared questions about the post-taper environment and what to do. For another day, Don Kohn, I thank you for joining us for this fascinating discussion on the FOMC and your excellent financial stability report. I've enjoyed it. I hope the audience has. Thank you for joining us. You're welcome anytime. Thank you.
Thank you, Mark. It's been a pleasure being with you, and those were good questions.